Okay, dear students, welcome to another class of accountancy. In the previous videos, we have discussed about dissolution concept, theory, and we also discussed which are the accounts being prepared when there is dissolution by the partnership firms. So today we will see the numerical part. We will try to solve one question on dissolution. We will see how the important accounts, that is realization account, partner's capital account, then partner's loan account and cash account being prepared in one particular question, which is question number 11 in the NCERT textbook. This is a comprehensive question, a model question. So we will just solve this question so that we get a clear picture on dissolution and how the accounts are prepared and how a particular question on dissolution is solved. Dear students, listen very carefully. First we go through the question on the screen. You can see left hand side there is the question given, and right hand side there are important accounts prepared, ledger accounts prepared, the format is given, and of course the journal entries are also there. Journal entries we will see later. As you can see, there are two partners, Rose and Lily, who are sharing in profit sharing ratio 2:3. Rose is getting 2/5, Lily is getting 3/5, and their balance sheet is given. It's a common balance sheet. In the balance sheet, you can see assets, liabilities, and there are adjustment also. Dear students, when you solve an accountancy problem, it's very important to understand the problem. Okay, simple reading of the question will not do. Okay, so actually there is a technique in solving every accountancy problems, whether short or long. Okay, you have to read the question at least. So this is the technique. You read the question at least 2-3 times, so that you get a clear picture of the question, what is asked, what is the information given. So you relate the items given in the question. So when you read it 2-3 times, you will know, or you will see sometimes some hidden items, some indirect information given, which may not be very much visible in the question. So in this way, you get a thorough understanding of the question and you see exactly what is asked, then you do accordingly, right? So in here also, you first read the question, you see the partners' names, the ratio, date, balance sheet, and the items given in the liability and the asset side, and you see if there is any special item provided, and you relate those items given in the balance sheet with the information provided below, the adjustment. That is also very important. Then of course you have to see the final question also, what is required to be prepared, right? Now we go to the balance sheet items. Of course, creditors given, normal thing. Lily's loan is given. This is partner's loan. Okay, Lily is the partner. You can see the second partner, and that partner's loan is given. So it is the loan given to the partnership business. So the partnership business, it is a liability. So from business point of view or partnership firm's point of view only, we have to think. So for the partnership business, it is a liabilities. That is why it has come in the liability side. Then of course profit and loss account is given. This is profit credit balance. Then capitals are given, no issue there. Assets are given, cash, debtors. Then inventory, which is the stock. Then bills receivable, building, both current assets and fixed assets are given. Both the current liability and the fixed liability is given in the liability side. Okay, now you read the adjustments. So in the adjustment, it is very clearly given they are dissolving the firm, and assets except bills receivable realized rupees for like 84,000. That means whatever assets are given here, except of course we should not be considering cash, and here it is also given without bills receivable. For excluding bills receivable, they are realizing the assets and the amount is given. Okay, we will deal with this particular information little while from now. And there is another information: bills receivable were taken over by Ross at rupees 30,000. The same information, it is a mistake in the question actually. The same information is provided here also. So what we would do, we will take this as the correct information. We will strike off this information. Okay, this 30,000 amount we will not consider, we will consider the amount of 33,000. Okay, now creditors are paid 38,000 rupees, it is clearly given. Then realization expense is given 24,000. This is realization expense. Then there was a motorcycle in the firm which was bought out of the firm's money. That means of course it is a business property, business asset, partnership asset, and it is not recorded in the books. So what do? We simply record the amount which has come, that is 10,000 rupees. When this motorcycle is sold in the market, we got 10,000 rupees. It is not there in the book, that is why we don't see this asset, this particular asset in the asset side, in the balance sheet, right? There is no asset given, there is no motorcycle given, so it is unrecorded asset. This is an example of unrecorded asset. Okay, so we simply record the money, the amount derived from the sale proceeds. At the same time, there is another liability which is contingent liability, right? Contingent liability is there. This is also a type of unrecorded liability because it is not there in the liability side. You can see it is not given. Okay, you refer the balance sheet. When you are reading the adjustment, you have to immediately refer the balance sheet also. Okay, so this 5,000 you have to pay. Whether it is recorded or not recorded, we have to pay it. It is our obligation. It is our liability, so we have to pay. Right. Now bills receivable is taken over by Ross. All the other assets are realized in the market. And money, okay, money received, bill receivable is not sold off in the market, it is taken by Ross, and this is taken by Ross for 30 at a reduced price. That is, here it is bill receivable 40 and 33,000. For 33,000 it is taken by Ross. You have to prepare your realization account, capital account, loan account, and cash account. These are the accounts which are required to be prepared. I think you got a clear idea about the question, about the partners, ratio, balance sheet items, and the sale proceeds and the settlements of liabilities. So in this way, you try to understand the question, study the question, get the summary of it, then start preparing the account. This is the correct thing to do in the examination. Okay, right. Now we start doing this realization account one by one. As you may remember, you just pick up the assets and liabilities one by one, then put it in the realization account. So you record the assets, you record the liability, then what are the how the assets and liabilities are settled, how the assets are sold and the liabilities are settled, you just record it. Nothing else. It's very simple. Just record assets and liabilities as it is given, then include the sale proceeds and or record the sale proceeds and settlement. So first step, dear students, first step, remember, you record all the assets. Okay, so these are the assets. You can see, pick up all the assets except this particular asset. Don't take it, because we have to prepare it. You can see we have to prepare separately. Cash account we have to prepare separately. Okay, so we pick up all the assets and we put it in the debit side, dear students. Now we start putting these assets in the debit side. You can see I am just writing the assets one by one. First asset, debtors. You see, when you write debtors, you take the gross value 80,000. Don't put this 76,400. Take the gross value. Okay, the bigger amount, that is 80,000, you put it here in the debit side. Okay, right. Now this provision for doubtful debts, immediately you put it in the credit side because it is liability, so it should go to the liability side. Put it here, right? Okay, now the next one is inventory. It is stock. Sorry, yes, stock. So put it there, inventory, put it there. 1,09,600, put it there. Right? You simply, it is like copy paste. Bills receivable 40,000, put it there. Okay, it is done. Buildings 2,80,000, put it there in the debit side. All the assets have come in the debit side. Now the liability, already one liability has come here, and we will pick up other liabilities, that is the creditors. 40,000 is external liability, so you put it there. Right, 40,000. Lily's loan will not come. This is not external liability, this is type sort of internal liability. Okay, Lily's loan, Lily is the partner, so that partner's loan account we have to prepare separately. You can see that we have separately we have prepared, so that item will not go to realization, it will rather go to Lily's loan account. Then profit and loss, we have to distribute it in the capital account, so it will go straight to the capital account, so we will not record it. Then capitals, of course we will not record it because partner's capital account we have to prepare separately, so it will not be coming in the realization account. So from these liabilities are only creditors will be coming, and this provision for doubtful debts, of course we have already taken it. Right? So first step, all the assets. Second step, all the liability, dear students. Listen very carefully. First assets, second liability. Now the assets you have to take very carefully now. Now come to the adjustment. Here it is said all the assets except bills receivable. So don't see the bill receivable except this bill receivable 40,000. Except that all the other assets, debtors, inventory, buildings, all collectively the assets were realized for rupees 4,84,000. That means all the other assets, debtors, inventory, that means stock and buildings, were sold in the market and 4,84,000 received. Okay, so this money you put it here by cash first, right? Then it is combined. No, for all you have to show it like, see, assets combined, you put it in the inside. Why we don't write straight? Because there are other items also which brings cash. So under cash there are different items. So if there are more items, more than one item, like 2 items, 3 items, 4 items, you write only one time by cash. No need to repeat it again and again. You simply write all the assets one by one. So here what are the items? First the assets for like 84,000 which you have written. Then there is another item, this motorcycle. I told you motorcycle, it is unrecorded asset, but when it is sold in the market, we have to put the money. This 10,000. This 10,000 you put it here, just below the assets, right? So asset is there, motorcycle is there, both brings cash, so we put it under cash, and these two are there. Okay, now is there anything else? So you can see it here. So this is the total cash derived. Okay, total cash realized through the sale of assets, both the recorded assets and the non-recorded assets. So the total amount is coming here, 4,94,000. In this way, you can see all the assets are cleared. Debtors, inventory, buildings. All the three cleared. It has come under assets. Then motorcycle is, it is given here, 10,000. Now where is this bill receivable? Bill receivable has not come. Remember, all the assets should be having the corresponding opposite entry here. So bill, where is the bill receivable? Bill receivable 40,000. It is taken by whom? By Ross. You can see it here, 33,000. So we put it here. Let us see. By rows, bill receivable taken. Now you can see the amount also you put it here, 33,000. Now you can see all these assets have been closed in this way, have been settled. I mean, all the assets have been realized. So all the assets will be realized, either it will be realized or it will be taken by the partners. So both we have done here. Understood? So assets part is over. Now liability part. Liability, provision for doubtful debts, we don't have to do anything because it is provision. Okay, it is not external liability, no need to pay it, no need to make the payment. So we concentrate on the creditors. So creditors 40,000 is there, and in the adjustment it is that creditors agree to take rupees 38,000. So this 38,000 we put it here, dear students, under cash, to cash, because cash is paid. So it will be coming as to cash. It will be coming in the debit side. We write it as to cash, and liabilities are settled. The first liability, creditors. Okay, creditors settled. So there will be some other liabilities. Then expense has to be paid. Okay, so 2-3 items may be there. So all those items will be coming under cash. Put it under cash one by one. So what my point is, no need to repeat to cash like that again and again. You write only one time, then put all the items which is coming under cash, put it together. So creditors 38,000, then which is other liability settled. There is one contingent liability you can see, and there is expense here, cost of expense, cost of realization 2,400. So this expense you may write first 2,400, then contingent liability I have written in short form. Contingent liability 5,000 rupees, it is written. So this three amount, this is the total payment. So take the total, put it here, 45,400, right? Total payment. So the total money received here 4,94,000, and total payment we made it 45,400, right? Okay. Now what is left? You have completed everything. You have completed all the assets, you have completed all the liabilities. Assets realized or taken over, liabilities paid or taken over. Here there is no liability to be taken over. Then expense we have noted down, then liability settled, everything is done. Now what we have to do? We have to close this realization account. Okay, so just to take the total, credit side, debit side, see which side is more. Of course, in this case, credit side will be more. So we just take the total and put the total here. Total is 570,600. Okay, do your totaling, and you will get this as a total. You can just check it out. 5,70,600. Then take out the balance here. Of course, credit side is more, so it will be written in the debit side. It will be profit, and the profit is coming as 15,600. You take the balance, you will be getting the profit 15,600, dear students. Now this 15,600 belongs to Ross and Lily, so it has to be divided in 2:3 ratio. So when you divide, you will be getting to realization profit. Ross is getting 6,240 and Lily is getting 9,360, which will be transferred to their capital account, dear students. Here realization account is over. Right? After realization account, we go straight to partners capital account. Very simple now, because you have done this partners capital account on admission, retirement, and death. Here also the recording is more or less same. Here balance brought down. Capital account has got credit balances. So first entry will be by balance brought down. Ross, Lily, you can get the amount from here. You can see the capitals. So these amounts will be going to partners capital account here, students. So you simply put it Ross 2,40,000, Lily 1,60,000. Now what are the other items? You can see this item, profit and loss account. You can see the tick mark, profit and loss account. You take, this is the previous year's profit. It has to be distributed. How much? You can see, if it is not visible, you can see 50,000. Okay, This 50,000 you have to divide, so you will be getting 20,000, 30,000. So divide it between Rose and Lily. So Rose will be getting 20, then 30. Okay, so first you put it profit and loss account, give it to the partners 20, 30. Right, total 50,000 is distributed. Right, now if you refer the realization account, you can see Rose is taking out the bills receivable. Okay, so it has gone to partners capital account. So from credit side, dear students, it will go to the debit side. Just see the side, it is very simple. Just opposite entry. This is what is double entry recording. Okay, so from credit side it will go to debit side, so it should go to Rose capital account debit side. How it will be coming? It will come as to realization account because it has appeared in realization account, so that asset should be coming here. So put it as to realization account. You write a small short narration. BR bill receivable taken 33,000. Put it under Rose. In Lily's column nothing will be there. Lily is not taking any asset, only Rose is taking the asset. So when Rose takes the asset, see that partner's capital account will get reduced. That is why it has come in the debit side. Okay, right. So realization account is written here, 33,000 has come there. Then now we have to see the realization profit, dear students. We have seen the realization profit, right? You can see this realization profit here. We have already calculated realization profit. So this is already gone. It has gone to partners capital account. So we have to simply record it here. From debit, it should go to the credit side. See how it is going? It is going to the credit side by realization account. You can see it here. Okay. Now all the items have gone. Opening balance have gone. Profit, previous year's profit has been divided. The realization profit has been given. Now you take the total. You take the total of Rose and Lily, both sides. You get the total. You get the total this much. Now find out the difference. So here Lily, it will be the same amount. Okay. So you can see the amount, you give the amount, and what you have to see. This is the due amount, dear students. So this due amount, it has to be given to them. Okay, dear students, now we have completed realization account and partners capital account, right? Now, what we have to do? We have to complete two more accounts here. One is Lily's loan account. Another one is cash account. Cash account should be the last account completed. So, since it is partners loan, we prepare partners loan separately and make the settlement accordingly. Okay, so now Lily's loan account is there. We have to put the opening balance. Opening balance is 32,000. So this is a liability. So a liability will have credit balance. So this loan account will have the credit balance. You can see it is written in the account in the credit side by balance brought down. Now you can see the amount is written. What is the amount? 32,000. So this 32,000, it is shown here in the credit side. So Lily's loan account has a credit balance of 32,000. Now what you have to do? You have to pay it, right? So this money has to be paid completely. So when we pay it here, right? Lily's loan account. Debtor to cash account will be the journal entry, and we write to cash. Of course, in the bracket we write settled and show the amount, full amount 32,000. So we write 32,000, dear students, right? So 32,000 balance is paid completely, and this loan account is paid. I mean, this loan account is closed completely. There is no balance. Okay, so after partners capital account, we have done partners loan account. So always when there is partners loan account given in the question, please draw the loan account separately and settle it accordingly. Okay, now the last account. We have come to the last account, that is the cash account. All the cash incoming, cash inflow, you put it in the debit side, and the payment you put it in the credit side. That's all. So the first step in the preparation of cash account is writing the opening balance. So opening balance you get from the balance sheet. You can see it is in the asset side. First item, this item we did not take anywhere. So this cash 16,000, it will be coming in the debit side of cash account. So simply write to balance brought down 16,000. So we have written the opening balance. After writing the opening balance, we take out all those cash entries from realization account, capital accounts and loan accounts and put it in the just opposite side. Okay, it's very simple. What we are doing in the cash account, we put all the cash inflow. When cash comes in, you put it in the debit side, and all the cash payment you put it in the credit side. And of course the balance should be written first in the debit side as the first item. So after writing all the entries, we close the cash account and we will get it tallied like this. We get 5,10,000 as the total of cash account both sides. So in this way we complete dissolution procedure through the preparation of realization account, capital accounts, then loan account if it is asked, and cash account. So these are the accounts to be maintained in the books of accounts when there is dissolution of partnership. And if journal entries are asked, we have to prepare the journal entries also. Okay, so one easy way of making this journal entries is to make the journal entries from the ledger account. It will be very simple. You see, you complete this realization account, and from the realization account you can make all the journal entries very easily. So these many journal entries will be there. And number one, the journal entry for the recording of assets. See, these are the assets. Okay, so what will be the journal entry? It will be combined journal entry. See, in the realization account you debit it, right? So what will be the journal entry? Very simple. Realization account after 2 debtors, 2 inventory, 2 bills receivable, 2 building. That is journal entry number 1. See, the first journal entry, right? Now second journal entry, it is for the liabilities. You see, only 2 liabilities are there. So put it just opposite. Provision for doubtful debts, debtor, creditors debtor, to realization account. That is the second journal entry, and you write the total in the credit side. Right. Now the third journal entry, you can take it as either for this one or this one. So here I have written as realization account debtor to cash account. You can see this journal entry, second one. So this is the entry, main journal entry to cash, realization account debtor to cash account, third journal entry. Okay, so cash account we write the total 45,400. So what is the journal entry? You can see the journal entry here. Realization account debtor to cash account 45,400, and you give the narration. In all the cases you give the narration very short. Okay, so in the narration you include those items: creditors, expense, contingent liability, etc. Okay, right. Now next journal entry you can see it is here, right here. This is the entry. Okay, this is entry. So this is cash account up to realization account, just opposite. So that is a journal entry you can see, 4,94,000, which is money received. So here you just remember the basic principle. Okay, like debtors, when we are closing the assets. So how to close an account? Close an asset account. Asset has got a debit balance. When you close, it will come to the credit side. So put it all in the credit side. Right? So in that way, or in this way, we close the assets account. So that is why assets have come in the credit side. So liability is just opposite. Then when cash is coming through sale proceeds, cash is coming. So you put it here, cash account up to realization account, you can see 4,94,000. When cash is paid, credit what is going out. So cash is credited here. In this way, you just understand the basic principles of this making the journal entries. It will be very easy. So from realization account, you can pick up all those entries one by one. It will be very easy. So for asset, for liability, then payment of liability, then asset realized, then of course this Ross is taking over bill receivable. So again, Ross to realization account, that is the journal entry. That is the next journal entry, asset taken over. Okay. Now realization profit. So again, realization account debtor to Ross to Lily, another journal entry. So 1, 2, 3, 4, 5, 6 journal entries you have to make. 6 journal entries you have to make. Okay. Then this journal entry, the profit or loss, it is given here. Dear students, we have given the profit or loss. See, this journal entry. This profit has come in the credit side of partner's capital account. So it should go to the credit side. So make the journal entry profit and loss account debtor to Ross and Lily. That is the journal entry. Okay. Then next journal entry is the settlement. Okay. So from capital accounts, this is the first journal entry. Then this is the next journal entry. Cash settlement. So again, Ross to cash, Ross and Ross is debited, Lily is debited. So Ross debtor, Lily debtor to cash. That is the next journal entry. Then the very next journal entry is about Lily's loan account, cash payment. You can see that here, dear students. See Lily's loan account. You can see how it is settled. So Lily's loan account. Okay. Lily's loan account, I will show it in a better way. Okay, you can see Lily's loan account debtor to cash. It is paid. Okay, Lily's loan account debtor to cash. You just imagine cash is going out, so cash is credited. Credit what goes out. See, cash account is credited, Lily's loan account debtor to cash account. Finished. So these are the journal entries you will have to prepare. So 1, 2, 3, 4, 5, 6, 7, 8, 9 journal entries in this particular case. So you have to make the journal entries in this way. Maybe combined journal entry or single journal entry, depending on different cases. For that, you may follow this ledger accounts, or you may follow simple rule of this making journal entries. And you prepare the journal entries, give narration, complete it. So if ledger account and journal entries both are asked, first write the journal entries, then make the ledger accounts. You can do it, you can have your own technique of making these journal entries and put it accordingly. So I hope you have understood how to prepare journal entries, how to prepare ledger accounts on dissolution of partnership of business.